Hello there, Andrew Bethel of the Bethel Law Corporation, and today we'll be discussing the new 2022 rules for the estate and gift taxes released by the IRS. To start, you should know that there are two types of gift taxes and exemptions, the annual and lifetime exemptions. Now, the annual gift tax exemption level has risen from $15,000 to $16,000, meaning you can give out that much money per year and never pay a tax. Remember, only the giver pays the taxes, not the recipient. And this is the first increase of the annual gift tax level since 2018. Now, this gift only applies between two parties as well. That means the giver can gift $16,000 to person A and another $16,000 to person B and still not pay any gift tax. Taking that further, a couple could each gift $16,000 to the same person and still not pay a gift tax. Gift taxes only kick in when gifting over the exemption level, now $16,000, to one person. However, the other type of gift tax is a lifetime gift tax exclusion, and it's tied to the current federal estate tax level. So beginning in 2022, at the start of this year, the gift and estate tax exemption levels have risen to $12.06 million per individual from $11.7 million in 2021. And this is according to the latest IRS inflation adjusted numbers. Additionally, you should keep in mind that one's annual gift tax exemption, that does not count towards one's lifetime gift tax exemption level. That means one can gift up to $16,000 to person A and another gift of $100,000 and still not pay a tax, as they've used their annual gift tax exemption and a small portion of their lifetime gift tax exemption, even if both of those gifts were done in the same calendar year. All this means is that those looking to gift money or provide an inheritance to their intended beneficiaries have a higher threshold to meet before causing a taxable event. Now, you may see these numbers and think, wow, they're so high that they'll never even apply to you. Well, yes, a gift of $12 million or even $16,000 is no small feat by themselves. There are situations wherein most of us may have to operate around these rules. And an example of that would be the qualification for public benefits for long-term medical care. For example, here in California, we have Medi-Cal, and that's California's administration of the federal Medicare program, specifically for California residents. And to qualify for that, these benefits, one's estate and income needs to conform to set rules and guidelines. Additionally, Medi-Cal even has a process for how to arrange one's estate to qualify without creating what they call a period of ineligibility. And this is a complicated process and really is one that we would never recommend anyone to do unless they first consult with an attorney on the matter. Now, our office does assist our clients with navigating this process by taking not only Medi-Cal's rules into account, but also the IRS's gift taxing rules as well. Thus, these rules have an effect on those with, for instance, a house and even a little bit of money in the bank. Of course, the main consideration for estates large enough to have to worry about the estate tax levels are taxes. Once an estate has exceeded the estate tax level, the taxes go up to around 40%, meaning a hefty tax bill for the family to worry about at these higher thresholds. Some see this, along with the high exemption level, as an incentive to gift property away during one's life so as to hedge against any future growth on those assets. For example, my parents gift me their house when it's worth about $300,000 because they expect it to grow in value quickly over time. Thus, only using $150,000 each, or $300,000 total, of their lifetime gift tax exemptions. They've now hedged against future estate taxes, right? Well, yes, but they have created some other problems here. If someone is thinking they need to go out and gift away large portions of their estate prior to their passing to hedge against the growth and the value of those assets, then they should also consider that it may still be more tax advantageous to keep those large assets in their estate after death so that the recipient, their beneficiary, can receive the assets with what's called a stepped-up tax basis for capital gains as of the date of death. So, for example, if my parents left me a house that they purchased for $200,000 but is worth $500,000 when they died and pass it on to me, then I can sell the house for $500,000 and pay zero in capital gains taxes, since my tax basis, the price I acquired the property at, was also $500,000. Tax-wise, it's akin to me not having made any money on the acquisition and subsequent sale of that home. Conversely, if my parents gifted me the house during their lifetimes when it was worth, say, $300,000, and I later sell the property for $500,000, then my tax basis for the property is actually that $300,000 value, even if my parents passed away the day before the sale. Because I acquired the property when it was worth that $300,000, that will determine my capital gains tax, and I would be paying taxes on that $200,000 growth in value rather than the $0 had my parents simply kept it through their lifetimes. So to wrap up here are some kind of points to keep in mind as well. Firstly, there are other capital gains exemptions that can apply on the sale of real estate, but those are really topics for their own video. Secondly, gifts can take many forms, and that's not just cash or real property. However, keep in mind that one can make unlimited direct payments for medical and tuition expenses for as many people as they'd like, and there's no gift or estate tax consequences for that, which is a very powerful tool to be able to, help somebody out. Third, as we are in the realm of taxes, that means we are in the realm of politics, which comes down to these numbers are always subject to change. The reason they are what they are now is due to the passage of that 2017 Tax Cuts and Jobs Act, which doubled the estate tax exemption from $5.49 million in 2017 to $11.17 million in 2018, indexed to inflation. And this is set to sunset in 2026, meaning it could be cut in half at that point. However, an earlier version of the Build Back Better Act cut this exemption in half, but that was later removed in negotiations back in November of 2021. Don't be surprised though if estate and gift tax exemptions continue to be bargaining chips on future legislation. Finally, some states levy their own gift and estate taxes, so this information, while federal, may not provide a complete picture to your prospects depending on where you currently live. However, in California, we have no state gift or estate tax, meaning we only need to worry about those at the federal level. Thank you for watching. Be sure to like, comment, and subscribe, and ring the little bell to stay up to date. Otherwise, we'll see you again soon.